What if I told you that the US is going to default on its debt this summer? That's what some people are saying. You've got others suggesting hyperinflation in the coming months. I don't know what's going to happen, but I can give you the information that highlights what I believe to be essential right now, including those who are talking about the US losing its monopoly and suddenly everything coming collapsing around it. I'm going to give you the actual truth though. Stick with me right here. Beginning with this. Bank reserves could fall between $900 billion to $2.5 trillion by year's end. This is not coming from some random analyst. This is Fitch. Okay, and I'll show you something from Moody's in just a second. That's as the Fed's quantitative tightening dries up liquidity in the banking system. Quote, tighter liquidity could exacerbate the ongoing shift to more restrictive credit conditions weighing on US growth. Just remember that in May, the Federal Reserve has their next meeting, and the expectation here, or this possibility, is that they're going to increase yet again 25 basis points, and then they're going to say, I think we're good for now, we're going to hold it right here. That would be something that is really important, and they've been waiting for this for a while, okay? So that's what's happening, but at the same time, tighter credit conditions put additional pressure on financial companies, corporations, and households. So you've got these problems that are widespread. And so there's concern, right? What's going to happen? The government cannot pay all of its debt, and all of these things start to add up. And that's why the rating agencies are starting to warn about this. Nothing will happen, but we can see the little bits of the puzzle starting to form. System-wide banking liquidity indicators are still robust, but our baseline projection is for reserves to fall significantly by $900 billion to $2.5 trillion by the end of the year. I'm interested to see what happens with this. The Federal Reserve balance sheet is still like gigantic, okay? So it started off at the peak at 9 trillion. It's coming down super slow. So we'll see what happens with that. It's not going to go to where they would have said, quote unquote normalization. That's all done with. There's no way that's going to happen. I'd be just paying close attention to see where it ends up. That's all. Moody's downgrades 11 regional banks, including Zions, US Bank, and Western Alliance. So I don't know if you deal with some of these banks, but understand that if we see this on the whole, I think, in my personal opinion, that it shows us the level of concern that's going on outside of, what normal people would talk about. Like, you're not going to see this on CNN and Fox because most people, they just don't get it. But you are here trying to learn all this stuff as we figure it out together. I'm a student of this, as are you. US bank deposits fall by $76 billion, led by large institutions. So we had the small banks, but look at this, large institutions. People are scared, they're moving their money out, and they're not taking any risk. You can see it's the lowest since July of 2021. There's a chart right here that dictates what's happening in visual form. Deposits fall to the lowest level since July 2021 in week ending April 12th. And there it is. So it went up a little bit, and some people thought, oh, okay, this is it, everything's fine, and now it has come down to even lower than where it was a couple weeks ago. So we'll see what goes on, but I just want to show you there's instability and volatility going on behind the scenes. You're not going to see that reflected in the stock market. If you think suddenly there's going to be a sell-off in the stock market because of this, it's not going to happen. It's all based on what the Federal Reserve says and does. That's it. Money mirror method. Remember that. Here we go. Money supply growth fell to 50-year low in February. Will the Fed panic? Well, this is part of what we've seen. I know other YouTubers have warned about this. Great Depression is going to be here tomorrow. In 90 days, you're going to see this happen and all these things. But let's be honest about it, okay? Is this true? Money supply growth fell to a 50-year low? Yes, no question. And we need to see, you can see right here, the year-over-year change, considerable. I talked about this, quite a while ago to show you this chart, M2. But what does it ultimately mean? Well, when you look at it, it just tells us that the Federal Reserve is encountering an issue. And while the Federal Reserve is only half the battle, we've got the Treasury and the government on the other side of that. I think it's important for a moment to step back and realize, look how, according to their metrics, how really strong the economy looks. Unemployment rate near record low. You've got the jobs, not seemingly an issue. I mean, there's millions and millions of empty jobs. People don't want a lot of them, but anyway, that's a different story. You take just what? Inflation, it's elevated, but has declined considerably. I mean, what other stats can we use? Their metrics show, hey, everything's pretty good. We just got to get inflation to come down, or we're going to leave interest rates up here for a little while. It'll calm everything down. So if this is the case, well, then they don't have anything to worry about. And that also means, on the other hand, they don't have to cut interest rates. So if they're not cutting interest rates and everything's kind of fine, well, then what's going on in the market? You see, the market believes all of this, belief that the Federal Reserve is going to cut interest rates literally this summer. So they're going to increase here in May, and then by July, maybe even September, they're going to cut interest rates. But why? If the economy is doing well? Well, could this be the reason? The money supply growth, not the money supply, but the money supply growth has declined. And that's something that we should be paying attention to, as I've talked about many times before. Keep that in mind, okay? But understand that it's really unusual to expect cuts right, like immediately after increasing. Strange things are happening right now. How a disappointing tax season has increased the risk of US default. So here we go. I did a video about this a little while ago, and basically I talked about the fact that you're going to have the default of the US, it's going to go bankrupt and all these different things. And I said immediately off the bat, that's what some are saying. And we know that's not going to be the case. We know that because the Federal Reserve is just going to increase their debt ceiling. They're going to get the tax dollars from somewhere. They're going to increase taxes on the middle class, and we know how it goes. In this case here, the risk of default certainly can elevate, and you can get the credit rating downgrade and all these things. That is real, that's possible. But in the end, the government is going to spend much more money. Your currency is going to be devalued. You will pay higher taxes, and this problem will be kick the can down the road, if you will. So that's just the way it goes. So you don't have to worry in that sense. You got to worry about the devaluation of your currency. People get into the politics side. Oh, this politician did that and the Congress didn't do that. At the end of the day, it's all about your currency. They're going to print more money, but they just wait until the last possible moment so that they can squeeze in a bill that has some very weird stuff in it that doesn't have anything to do with that bill and what it's supposed to stand for. Accountant shortage leaves some U.S. cities without credit ratings. I mean, this is just unusual. S&P withdrew ratings on 64 local governments, utility systems. Missing ratings worrisome with economic headwinds ahead. Isn't it kind of like, you've got somebody, just think about that. There's no referee, if you will. There's nobody at the watchtower. NORAD standing down. Oops. These things, they're there, and then maybe they won't see some of the warning signs. I don't know. I just thought it was interesting. And here we go. So this is the CDS on the US. And if you could believe it or not, looking at this, actually it's CDS, but anyway, the point is it's credit default swap, and that is the risk that there's going to be a problem. And it's higher today than it was during Lehman, during the US debt downgrade and debt ceiling crisis. So there are concerns that are going on behind the scenes. That's all I'm trying to highlight, as I did just a moment ago. Fed officials on track to hike rates and signal potential pause, as we discussed a moment ago. And I'm not so sure that they will increase by, beyond May. I really don't know. But this seems, relatively likely that we could see in May. That means the interest rates will be the highest they have been in a very long time. That puts additional strain on borrowing costs, doesn't it? So here we have it. What's going on with real people, regular people, you and I? Most Americans don't have a clue about what their healthcare expenses will add up to in retirement. Many even think that once they reach 65, Medicare will cover most, if not all, of their medical bills. But you can see here, half of the 35 million older adults and younger persons with disabilities with traditional Medicare expenses, at least 16% of their income on out-of-pocket healthcare costs. Looking at how much premiums people are paying is so much, so much more expensive. And this is something that is going to receive some hefty inflation around it. Think about that. When you calculate this nonsense inflation stats that they use, you think about it for yourself, where you are today. Let's say you were 50 and you're like, okay, when I'm 65, this and that. 15 years. Imagine 15 more years of money printing, and where they're going to bring interest rates, they're going to bring them down low. We know that. What's that going to do to the cost of everything, including healthcare? You've got to realize this. You have to. Okay, I'll talk about that at the end, what you have to be aware of. This is essential. Stick with me for a second here, okay? Look, a recession could be coming, but markets don't appear to be that worried. That's because a downturn could resolve three big issues that have weighed on the stock market. Markets see a recession as a feature, not a bug. Come on. I mean, this is ridiculous. But they worry about a recession, but what happens? Oh, don't worry. They're just going to print more money, right? US equity markets are not just looking past the upcoming recession, but actually embracing the possibility of an economic contraction. It's so silly now. Markets, I remember in 2020, markets are forward-looking. Markets are forward-looking. That's all they kept saying. It's like, okay, the problem's going to be resolved, so just look beyond it. You can't really do that, because if you're holding some stocks, if you're holding some parts of the world or something that suddenly have some serious turmoil, you're going to be in big trouble if you just overlook everything. You don't want to get too focused on the day-to-day, but come on. Look at this, visualizing the US debt in $1 bills. I just thought it was a nice graphic here. If you could either pause the video or zoom in, just looking at that. I mean, trillions upon trillions. It's $31.4 trillion. This is the Willis Tower. It is 1,450 feet. And just compare that to all that cash stacked up. I mean, it is incredible, isn't it? So that's where we're at. For a lot of people, they're wondering, what can I do about it? Okay, buddy, what can I do about it? Well, as always, I got to talk about the pillars of prosperity. That means you have your self-sufficiency and your preparedness. You can also be looking around your neighborhood and your area for people who have different skills, different products, or different, knowledge, whatever the case may be, that you don't have, and you could partner on this. You happen to be a mechanic. I just heard from you in the comments section saying that, hey, I'm having the ability to actually be a mechanic from home, getting a car lift, and then I'll be able to service people's vehicles from my own house as a side hustle. Or maybe if I get laid off, hey, I could still do this. I could bring in income. That's the way it's got to be. That's, in my opinion, part of it is like self-sufficiency. You could take care of himself, but at the same time, the other pillar is increasing income. And if you could do little things, even oil changes and car detailing, whatever the case may be, you are bringing money in. I just heard about this, $200 for car detailing. Now that is a service that comes to you and they do it like super nice, wax the car, all that. $200. How long could it possibly take? Few hours? If you could do even one a day for most people, that would be fantastic. Okay, so look into these things. You wouldn't believe it. You go to the more affluent areas and you can use your services, your skills that you have today. That's my message. Check out Pillars of Prosperity, the Money GPS. I got it right on the screen right here. Pillars of Prosperity. I'll see you there.